Over half of China's economy is now shrinking, with youth unemployment hitting record highs. Has China entered the doom loop? Fresh data says China's exports are plunging at the fastest pace since the COVID lockdowns, 14.5% down on the year. That's mainly driven by a 23% drop in exports to the U.S. and a 21% drop to Europe and most of Asia. Meanwhile, imports are also falling 12.5% on the year as factories in China buy fewer inputs and Chinese households reduce spending. In short, foreigners aren't buying and Chinese aren't buying either. This is all a problem for Chinese factories because they are obscenely overbuilt thanks to cheap money. To give a sense, Chinese car makers can produce 40 million cars a year, but Chinese only buy 20 to 25 million. China's now actually throttling new car production, denying them production licenses, even as the U.S. is pouring billions of taxpayer dollars into an industry that will soon be swamped by cut-rate Chinese EVs. Now, manufacturing makes up just over 27% of the Chinese economy, and it has contracted for 4 straight months now, bringing quarterly GDP growth nationwide to just 0.8%. That's pretty low for China. The economy just officially entered deflation for the first time since the 2008 crisis. Meanwhile, in the rest of the Chinese economy, their comically indebted housing industry, also roughly 1/4 of GDP, is showing new distress. Major home builder Country Garden, which was held up by China's government as the poster child of prudence, just missed 2 bond payments on their total $200 billion in debt, leading to a debt downgrade from the now famous Moody's. Considering this is all coming with youth unemployment at a record high, over 20%, it could spell political trouble. So what can China do? The exports are largely out of their control. It's basically our recession talking, and that's likely to get worse, meaning more plunging exports and falling factory prices in China. Eventually, enough Chinese factories close that the overcapacity dries up and prices can recover. Of course, that could mean millions more freshly jobless Chinese youth. As for domestic demand, including housing, China's go-to whenever the economy slows is to crank out more cheap money, cutting interest rates and handing tens of billions to home builders or local governments digging holes and refilling them, so basically the same as we do. The problem is that China is now swimming in debt, over $50 trillion in non-financial debt, which is even higher than the U.S. I mentioned in a recent video how this raises fears of a Japan-style deleveraging with potentially years of slow growth. Deflation, of course, makes all of those debts even bigger. China taking over the world has been the story of the decade, and now it is running into reality. I don't think they're doomed, but they are going to need to pull some big rabbits out of their hats. And what is next for us? Expect China to flood the world with even cheaper goods, which is great for our consumers. It should take some of the edge off inflation short term, but it could also wipe out what's left of American and European manufacturing, both already on the edge from suicidal green mandates. It turns out central planners in China are almost as bad as ours, and now millions get to pay the price. Okay, we'll be watching. See you next time.